People often ask how much money arrived. But a better question is, what changed after it arrived? Across many African countries, development finance did not just provide capital. It often came with conditions. And those conditions could reshape what governments were still allowed to do. A development loan is not simply money. It can also function as a policy instrument. In public language, a package may be described as support. But behind that label can sit subsidy reform, currency devaluation, privatisation, spending restraint, liberalization requirements. That is why the amount matters, but the terms matter more. In Ghana, reform cycles linked to external financing repeatedly brought debate over subsidy systems, pricing, and fiscal restructuring. When subsidy systems are cut or narrowed, the effect is not abstract. It appears in fuel costs, transport fares, household budgeting, the price of daily life. That is why development finance cannot be understood only through national announcements. It must also be understood through everyday affordability. In Zambia, debt pressure and reform cycles show how financial stress can narrow policy room. Once debt servicing becomes central, governments do not simply choose from an open menu. They often choose from a smaller one. That affects spending priorities, infrastructure sequencing, subsidy debates, fiscal flexibility, bargaining power. The issue is not only whether money arrived, it is whether policy autonomy remained intact. In Tanzania, liberation debates help illustrate another part of the story. When lending frameworks push changes in market organization, pricing systems, or the role of the state, the impact is structural. This is not just about one project. It is about how economies are reorganized. That is why the real question is not, was there funding? The real question is, what kind of system did the funding encourage? This is why the language of aid can mislead. It sounds moral. It sounds simple. It sounds generous. But in practice, the architecture may include debt, conditionality, leverage, institutional pressure, long-term repayment discipline. So the word may sound soft, but the system can still be hard. When people discuss development finance, they often count the money. But the deeper question is what happened after the agreement. What changed in prices? What changed in subsidies? What changed in public spending? What changed in state capacity? And who still had room to decide? Part 3 asks the central question, when the money arrives, who keeps the power?